Good afternoon, everybody. Welcome to Liberty Call. It is Thursday, October 27th, 2022. Hope everybody's having a great day out there in the interwebs. It is a cold and chilly day here in Colorado. We are getting our first snow. Let me share with you what's going on outside my house. You can see my driveway and cars are covered with 2 to 3 inches of snow right now. Should stop sometime here in the next hour or two. But yeah, it's the white stuff's fallen, and probably a week or probably about 2 weeks beyond when we normally get our first snow. But it is what it is. Hopefully, it looks like it's melting mostly on the driveway, so I won't have to go out there and clear it. But anyways, if it's your first time watching, please press that subscribe button. Give me some big old thumbs up, likes or shares or whatever the hell it's called on whatever platform you're watching on. I would greatly appreciate it. And, kind of a mixed day here domestically in the markets. You can see my director of security back here, Barney. He was very worried about what's going on in the markets. So, all right, well, let's go ahead and dive in. The Dow Jones was up 0.61%, closed at 32,033. S&P 500 was down 0.55, closed at 3809. NASDAQ down, not real good today, down 1.63, closed at 10,792. Small caps were down 0.43. VIX rose 0.4%, up to 2739 right now. Canada was up 0.38. Brazil was up 1.93. Mexico down 0.9. Headed over to Europe. Let's see how they did earlier today. Germany was up 0.12. UK was up 0.25%. UK was down 0.51. Euro stocks was flat, down 0.02. Netherlands up 0.57. Spain up 0.64, Italy up 0.9, Switzerland down 1.02, and Portugal was down 0.3%. Head a little further east. Both Russian exchanges were in the green today. The MOEX was up 2.08, RTSI up 1.57. And in the overnights in Asia, Japan was down 0.32, Australia up 0.5%, New Zealand up 0.4%. Looks like the Chinese markets were mostly red. The Shanghai was down 0.55. The SESE component was down 0.63. China A50 down 1.5. DJ Shanghai down 0.53. The Hang Seng was up 0.72, and the Taiwan weighted came in up 1.55. So kind of a mixed day globally. But again, some good news and bad news came out of the economy today. So, we shall see how things are going. All right, well, let's churn through today's market recap. S&P 500 slips as Mega Slide and Meta weighs. The S&P 500 slipped Thursday as Meta-led slump in big tech offset a jump in cyclical sectors, including industrials and energy stocks. Meta platforms fell 24% after reporting third quarter results that missed on the bottom line and were an absolute train wreck, end quote, Wedbush said in a note. The results reflect the, quote, pervasive digital advertising doldrums ahead of Zuckerberg and co. as they make the risky and head-scratching bet on the metaverse, end quote, it added. Meta's results arrived just a day after Alphabet and Microsoft reported underwhelming quarterly results. Apple and Amazon closed their curtain on big tech earnings this week with reports after market closes. Caterpillar, however, provided plenty of optimism for investors after reporting better than expected quarterly results as price hikes and higher sales volume bolster the heavy equipment company's growth. Honeywell International, another industrial heavyweight, also delivered a beat on the bottom line, sending its shares more than 4% higher. Boeing jumped more than 5%, recovering some losses after a day earlier when the aircraft maker reported a bigger than expected loss. McDonald's, I'm loving it, Corporation, a major Dow component, was up nearly 3%, underpinned by better than expected quarterly results amid rising consumer traffic, right? Because people are, running short on cash, so they're eating that trash that McDonald's sells. Energy stocks were driven more than 1% higher by rising oil prices, with Marathon Oil, Baker Hughes, and Valero Energy leading to the upside. On the economic front, meanwhile, the U.S. economy rebounded in the third quarter, growing at a 2.6 annualized rate, driven by a jump in exports, though this is unlikely to persist given the stronger dollar, RBC said. With the Fed hiking interest rates, quote, aggressively, end quote, RBC expects GDP growth to slow in Q4 and a recession to follow next year. Treasury yields, however, continued their retreat from recent highs, with the 10-year Treasury yield slipping below 4% as investors continued to bet that the Fed is closing in on peak level in rates. We shall see. I think they're probably going to have to go a little higher. Quote, over the last 6 hiking cycles, bond yields have typically peaked a couple of months before the peak of the Fed funds rate itself, end quote. Oxford Economics said in a recent note, quote, we are therefore likely nearing a peak in yields, which we expect to be around 4% at the end of the year, end quote. All righty. So let's dive into a little bit more news as far as the GDP. Yellen says, she's the Treasury Secretary, says that GDP data shows strength, but also a healthy slowdown. U.S. Treasury Secretary Janet Yellen said Thursday that new GDP data shows strength in the U.S. economy, but also some evidence of a healthy slowdown that could have a positive impact on fighting high inflation. Speaking to reporters on a trip to Cleveland to tout the Biden administration's economic policies, okay, Yellen said she still does not anticipate a recession, but the U.S. government has fiscal capacity to respond to economic weakness if appropriate. So she doesn't think there's going to be a recession. She's not very bright. Typical government worker. The U.S. economy grew 2.6% in the third quarter, rebounding after contractions earlier this year. But the Commerce Department data overstated the nation's economic health, as domestic demand was the weakest in 2 years because of the Federal Reserve's aggressive interest rate hikes. Well, they probably wouldn't have to raise interest rates if they didn't print $5 trillion and increase the money supply by 40%. But hey, what do I know? Let's see here. Quote, this is certainly a full employment economy with a hot labor market, which is good, but we want to see growth slow, end quote, Yellen said. Quote, it's part of getting inflation under control, end quote. Quote, I've said many times I see a path to bringing inflation down while maintaining a strong labor market, and I think data is consistent with what we want to see, end quote, Yellen added. Yellen said she expects the economy to slow further and the government has fiscal space to respond if necessary, but cautioned that this should not work against monetary policy. Quote, we need to be careful not to use fiscal policy to exacerbate inflationary problems. I think that's what they did 2 years ago. Yellen said, quote, but if there were, which I don't expect, but if there were a deep recession, that was something that called for a response, I think we continue to have enough fiscal space to do so, end quote. Again, I do not find this woman credible or competent in her job, but she seems to continue to get high-ranking positions. So it is kind of puzzling to me. All right, some jobs data came out this week. Weekly jobs data claims rise to 217,000, Labor Department. The number of Americans filing for unemployment grew by less than expected last week. According to the data from the Labor Department, seasonally adjusted initial jobless claims during the period totaled 217,000, up from an unrevised prior level of 214,000. Economists had predicted the reading would increase to 220. The 4-week moving average, which aims to smooth out volatility in the report, also moved higher by 6,750 to 219,000. So, but again, the jobs numbers still look really good. So. And they are a lagging indicator. So typically the economy starts to falter, then companies start slashing their books. Then you start to see the jobs numbers start to get really ugly. So I would expect the jobs numbers will probably look good through the end of the year. That would be just my gut feeling on that, simply because of the holidays and the spending that is typically generated there. All right, next up, diesel reaches unacceptably low levels. How could it impact winter heating costs? This is not good news, especially if you drive a diesel truck or you are a truck driver or you like staying warm in the winter. A dire shortage of diesel fuel in the U.S. could keep inflation high and make costs of heating surge throughout the winter. National Economic Council Director Brian Deese told Bloomberg TV on Wednesday that new government data released that day shows diesel levels are, quote, unacceptably low, end quote, according to a Newsweek report. To put it into perspective, the country has only 25 days of diesel supply remaining, according to the Energy Information Agency. That is not good news. The shortage was driven by the cost of has driven the cost of diesel way up. I know I paid over, it was $5.15, and with my 40% or 40-cent discount from Kroger, I paid $4.75 for 35 gallons, and it was an expensive bill the other day. Let's see here. The shortage is driven by diesel costs way up. Diesel prices are approximately 50% higher than they were this time last year, hovering at $5.32 a gallon, according to data published by AAA. Diesel is used for fuel trucks, ships, tanks, and other vessels. Because heating oil is extremely similar to diesel, demand for heating oil is expected to surge, causing housing heating bills to go through the roof, USA Today reported. The U.S. is now scheduled to get at least 90,000 metric tons of diesel and jet fuel arriving from the United Arab Emirates. According to a report from Reuters on October 14th, this could provide some relief. The main factor causing the diesel shortage is the Russian invasion of Ukraine. Okay, sure. Diesel imports from Russia have been banned since Putin's war began last February. I mean, we only get about 10% of our oil from the Russian market, so I don't necessarily think that is truly the real thing. I think it's more of an excuse. All right, last up, article here about home prices. U.S. home prices could plunge 20% next year as mortgage rates surge. So, if you're getting ready to sell, now may be the time. You may have to then sit for a while and wait for prices to come down to a level you like. Anyways, home prices are already falling at the fastest rate in decades as mortgage rates march higher and could tumble another 20% next year, according to a noted Wall Street economist. Ian Shepardson, the chief economist at Pantheon Macroeconomics, said in an analyst note published last week that there is, quote, no floor in sight, end quote, for declining home sales, with mortgage rates approaching 7% for the first time since 2001. He anticipates that home prices will plunge by 15 to 20% next year. Quote, we expect home sales to keep falling until early next year, Shepardson wrote in a note. By that point, sales have fallen to an incomprehensible minimum level where the only people moving home are those with no choice due to a job or a family circumstance, end quote. Sales of existing homes have already tumbled 1.5% in September from the previous month to an annual rate of 4.71 million units, according to data released last week by the National Association of Realtors. On an annual basis, home sales plunged 23.8% last month. Many experts, including Shepardson, agree that the housing market is now experiencing a recession that will worsen as the Federal Reserve continues to raise interest rates. Quote, if you're planning to move homes and need a new mortgage, you will face huge increase in rates, Shepardson said. It's entirely possible that even people who want to trade down will face a bigger monthly payment. That's a good reason to stay put, thereby constraining supply, end quote. The Federal Reserve is tightening policy at the fastest pace in 3 decades as it tries to crush runaway inflation. Policymakers have voted to approve 5 consecutive interest rate increases this year, including 3 consecutive 75 basis point hikes in June, July, and September. At the conclusion of their meeting last month, Fed Chair Jerome Powell signaled that another 125 basis points, or 1.25%, of rate increases are on the table this year, and that the rate hikes have already driven the average rate of a 30-year fixed-rate mortgage to 6.94%, according to Freddie Mac, double what they were just 1 year ago. With mortgage rates rising, demand for home sales is rapidly drying up, prompting home prices to fall. So again, could have called this a long time ago. I think anyone who's paying attention to or in the mortgage business knew that this was certainly a possible reality. It'll stabilize at some point. Rates will then come back to some normal point. Probably mortgages in that 5 to 7 range. Once inflation is back to an acceptable level. But again, this could have all been avoided. I've said this for 2 years now. There was no need for all the spending that we did. I think most of it wound up in corporate America's pockets. But hey, had to do something. That's the do something crowd is sometimes the worst thing possible. But sometimes doing nothing is the right thing. Sometimes whether or not it's managing a portfolio. Sometimes it's just sitting on your hands and just waiting for things to happen, or sitting in cash and waiting for things to collapse. But hey, sometimes people just want action for the sake of action. But all right, well, that's everything I had for today. I hope everyone has a fantastic evening. If you need anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I'll talk to you guys tomorrow. Bye-bye.